Are you tired of feeling lost when it comes to investing in the stock market? Let's change that today. Hey there, welcome to the channel. Today we are talking about one of the most important topics in investing: index funds and ETFs. With so many options out there, it's easy to get overwhelmed and make a decision that's not in your best interest. But don't worry, we're here to help you understand why we prefer index funds over ETFs. Have you ever heard the saying, "Don't put all your eggs in one basket"? Well, the same principle applies to investing. Diversifying your portfolio is key to reducing risk and maximizing returns. That's exactly what index funds and ETFs offer. But what's the difference between the two? And why do we believe index funds are the better option? Stay tuned, because we are about to break it down for you. Are you ready to learn why index funds are the go-to investment choice? Let's dive in. What are index funds and ETFs? Starting with index funds, these are investment funds that aim to track the performance of a specific market index, such as the S&P 500. This means that, as an investor, you're essentially investing in a basket of stocks that represent a broad cross-section of the market. By doing so, you're able to gain exposure to a diverse range of companies, reducing the risk of investing in a single stock. Now, let's move on to ETFs, or exchange-traded funds. Similar to index funds, ETFs also aim to track the performance of a market index. However, they are traded like individual stocks on an exchange. This means that they can be bought or sold at any time during the day, just like a stock. ETFs can also contain a wider range of assets, including stocks, bonds, commodities, and even currencies. So what is the difference between the two? Firstly, index funds are typically more cost-effective than ETFs, as they tend to have lower management fees. This is due to the fact that index funds are passively managed, whereas ETFs have a more active management approach. Additionally, index funds can only be purchased or redeemed at the end of the trading day, whereas ETFs can be traded at any time during the day. Another important aspect to consider is liquidity. ETFs are more liquid than index funds, as they can be bought or sold at any time during the day. On the other hand, index funds can only be purchased or redeemed at the end of the trading day, which can impact their liquidity. Advantages of index funds. Now let's dive into the advantages of index funds. One of the biggest advantages is cost. Compared to other types of investments, index funds tend to have lower fees and expenses, which can add up over time and have a significant impact on your overall returns. This makes them a great option for long-term investors who want to keep their costs low. Another major advantage of index funds is diversification. By investing in a broad range of stocks, bonds, or other securities, you can spread out your risk and potentially achieve better returns over the long term. This is because index funds provide exposure to a broad range of assets, rather than just a few select stocks or bonds. This helps to reduce the impact of any individual company or market event, making your portfolio more stable over time. Index funds are also incredibly easy to manage, which is another advantage. Unlike other types of investments that require active management and monitoring, index funds simply track a particular market index, so there's no need to constantly buy and sell individual stocks or bonds. This makes them an ideal choice for those who don't have a lot of time or expertise to devote to managing their investments. Disadvantages of ETFs. ETFs have been all the rage lately, but they do have some disadvantages that need to be considered. Firstly, ETFs can be complex to understand. With so many different options available and a wide range of factors to consider, it can be hard to know where to start. This complexity can make it difficult to choose the right ETF for your investment portfolio and make informed decisions about when to buy and sell. Another disadvantage of ETFs is the high trading cost that can come with them. ETFs are traded on the stock exchange just like stocks, so there are transaction fees to consider. These costs can eat into your returns and make it harder to achieve your investment goals. Also, ETFs can be subject to bid-ask spreads, which are the difference between the highest price a buyer is willing to pay for a security and the lowest price a seller is willing to accept. These spreads can further erode your returns, making it important to consider the cost associated with ETFs before investing. Why we prefer index funds. One of the biggest advantages of index funds is their lower costs. Because they are passively managed and aim to simply track the performance of a particular market index, they typically have lower fees and expenses than actively managed funds or ETFs. In addition to lower costs, index funds also offer diversification. By investing in a large number of stocks, bonds, or other assets, you can help spread out your risk and reduce the impact of any single investment on your portfolio. This can be especially important in volatile markets or during times of economic uncertainty. Finally, we find that index funds provide consistent returns over the long term. While individual stocks or bonds may see big fluctuations in value, the broad market has historically tended to rise over time, providing investors with a steady stream of returns. How to choose an index fund. When it comes to investing in index funds, it's crucial to do your due diligence and choose the right one for your financial goals and risk tolerance. Here are some steps to help you make an informed decision. Assessing your financial goals and risk tolerance. The first step in choosing an index fund is to determine what you're trying to achieve with your investment. Do you want to save for retirement, pay for a child's education, or generate passive income? What is your time horizon for reaching these goals? It's also essential to assess your risk tolerance, which refers to your comfort level with market fluctuations and the possibility of losing money. Researching different index funds and their performance. Once you have a better understanding of your financial goals and risk tolerance, you can start researching different index funds. Look at the historical performance of various funds, their fees, and the level of diversification they offer. You can find this information on the fund's website, in its prospectus, or from financial advisors. You should also consider the size of the fund, which can affect its liquidity and risk level. Deciding between passive and active management. Index funds can be either passively or actively managed. Passive management means that the fund tracks a specific index, such as the S&P 500, and its returns are based on the performance of the underlying securities. On the other hand, active management involves the fund manager making decisions on which securities to include in the fund, with the aim of outperforming the market. So to recap, we've covered the basics of index funds and ETFs and compared the advantages and disadvantages of each. To recap the key points, index funds offer lower cost, diversification, ease of management, and high returns over the long term, while ETFs can be complex, have high trading costs, the risks of over-diversification, and market volatility. Personally, we prefer index funds because of our personal experience, lower cost, and the consistent returns that come with a diversified portfolio. What are your thoughts on index funds and ETFs? Have you invested in either of them? Tell us in the comments section below. Also, if you're new to this channel, we strongly encourage you to subscribe and click the like button, and share the video if you enjoyed it. You can also keep up with all of our most recent videos. See you in the next one.